We've all heard of a black swan event. Investopedia defines it as an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Now, notice they said unpredictable, but if you look at this post from Investopedia, they give examples of black swan events, such as the hyperinflation in Zimbabwe, the dot-com bust, the GFC in 2008. So if you actually think about it, these events are predictable. Many people predicted the GFC as an example. I'm going to explain what I think the next black swan event could be, something we could see potentially even in 2024, and why the economy may not survive. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the dollar, what it has done lately, and think about this through the lens of dollar-denominated debt. I've got a chart going all the way back to, well, not that far back, July of this year. We go to today's date. On the left, we go from 100 up to 107. This is the DXY. So a measurement of the dollar relative to a basket of other currencies, mostly the euro, about 57% euro, I believe. And in July, the DXY was right around, call it 102.5. It goes up, then it comes all the way down to 100. But since, let's just call it mid-July, the dollar has gone straight up to a point just the other day where it got over 107. To understand why this is such a big deal, we need to use some very simple technical analysis. And when you're looking at charts, they've got something called resistance levels. So this is a level of price where the stock, let's say, or in this case, the DXY, has gone to in the past several times. And then it comes back down and it goes back up to that point, to that resistance level. So the technicians, the people who study and do chart analysis for a living, would say once it goes through that resistance level, there's a high probability that it's going to go up to the next resistance point, or it's going to come crashing through. And now this resistance level becomes somewhat of a floor. So editor, let's go ahead and look at the DXY, but let's zoom out a little bit and go back in time. And we see that we had a resistance level at 105.6. That's something I've been watching on the Rebel Capitalist channel for a long time. And we smashed through that resistance level last week. And as we can see by the chart, it went up and it's continuing to go up. So the next question becomes, okay, where's the next level of resistance? And that comes in right around 112, 113. And this is key. Why, George? Why is that such a big deal? Because once we go through that, assuming that we do, the next stop is likely 120. And when we get to the 120 level, then the debt really becomes a problem. I mean, when we go through the 105 mark, I would argue we're already in the no bueno zone. That's a very technical term that I use. And this process of the dollar going up and up and up against other foreign currencies is very negative for the global economy. More on that in just a moment. But if we get to 120 or higher, I think that's when the government is going to have to come in and take action. More on that in step number 3. So to recap, we just broke through the resistance level at 105.6, and it looks like the next stop is going to be 113. If we exceed that, the next place the chartist will tell you we could head, or the highest probability, is going to be 120. And once we get to 120, that's going to mean big, big problems for not just the global economy, but the U.S. economy. So why is the dollar going up and up and up and up in value such a big problem? Okay, let's go to the average yo. It's not the average Joe. No. It's his Chinese cousin, the average yo. So we've got the average yo right here, and you can see he's not really bummed out, not really happy, kind of indifferent to the situation, because he has $2 worth of debt, dollar-denominated debt. But right now, the yuan, represented by this red Y, is, let's just say, at parity with the dollar. So that means that 1 yuan is worth $1. Okay, so he's got these $2 of debt, but this represents his cash flow. So he has 2 yuan in cash flow. Therefore, he can easily pay his dollar-denominated debt. So above the line represents his cash flow. Below the line represents how many yuan he needs to pay off his dollar debt. Okay, let's move on. So now let's say the dollar appreciates in value relative to the yuan, but his cash flow is still 2 yuan. But now, because the dollar has appreciated, in order to pay his $2 of debt, he needs 3 yuan. You can see where this is going. And let's just assume for a moment that the global economy is slowing down, or the Chinese economy is slowing down, which we all know that it is dramatically. So now it really puts the average Yo into a bind. And you can tell how his facial expression is getting worse and worse and worse, because he still has that $2 of debt, but now, because the dollar's appreciated, he needs 3 yuan, but he doesn't even have 2 yuan in cash flow. He only has 1 yuan because the Chinese economy is slowing down. So obviously, this quickly puts him into a position where he cannot pay his debt. Okay, well, one man's debt is another entity's asset. And what entity would hold that debt as an asset on their balance sheet? You guessed it, a bank in the Eurodollar system that is responsible for providing dollar liquidity to all the other corporations in the global economy. Let's call it Corporation XYZ. And let's remember that those corporations provide the stuff that you buy at Walmart, Target, and Home Depot. So if they can't get the dollar liquidity they need because the average Yo isn't paying off his debt, which is the bank's asset, so they're tightening credit conditions, they're reducing the dollar liquidity available, then that means that there's less stuff going into the United States, less stuff to buy. And we know that the US economy is 70% consumption. So this puts the average Joe into a very difficult position, as you can tell by his facial expressions. Because there's less stuff to buy, the US economy is starting to shrink, but unfortunately, it gets worse for the average Joe, because the United States is definitely a net importer. We run huge trade deficits, but we do export some things. And if the global economy is slowing down, if the average Yo has less purchasing power, that means less stuff that he's buying from the US exports that we do have. So after going through this thought experiment, it becomes crystal clear why the dollar going up and up and up is not only a problem for the global economy, but also a huge problem for the US domestic economy. And let's quickly go back to that definition of black swan event. Remember, it reads an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. So how many of you watching this video right now have the dollar going up in value as the next black swan event on your bingo card? I would argue very few of you believe that the next GFC, let's say, will be a result of the dollar increasing in value. In fact, probably most of you have the opposite, that you would say the next GFC or the next black swan event would be the dollar crashing. But maybe, just maybe, it's going to be the dollar crashing up. Step number 2, but the value of the dollar relative to other currencies doesn't just impact dollar-denominated debt, also impacts something that's crucial to every single economy around the world. Those are commodities, energy, wheat, corn, soybeans, copper, etc. So check out, see what's happening to commodity prices, remember priced in dollars, and think through how this would impact the average Yo in China that's struggling right now just to pay off his dollar-denominated debt because of the increase in the value of the dollar that we discussed in step number 1. First, let's go to the price of oil. And we can see that just in the last 3 months, it's gone higher. Now, it has come down recently, and that's great news for the global economy and the US economy, I might add. But in the last 3 months, it's gone from, call it $73 up to just under $85. So if you're the average Yo and you have to take your yuan, and even if you settle in yuan, it doesn't even matter. If the price of oil that you're importing, because you have to have that to survive, I mean, forget the economy. Now we're talking about survival. We have to have energy to survive. We have to have commodities to survive. So if that barrel of oil that's coming in is now $83 instead of, let's say, $73, and the value of your yuan has been cut in half, let's just take it to an extreme so we can all get our head around this and assume that 3 months ago you could buy a barrel of oil for $1. And let's say that the yuan was equal to $1. They were parity. And now let's say it costs you $2 to buy that barrel of oil. Okay, well, what are you going to do? You need twice as much yuan. Well, where are you going to get it? Who knows? And what's happening to your economy? What's happening to your dollar-denominated debt? You can see how very quickly the global economy can go from being in a position where they're all right, they're paying their expenses, they're paying their oil bill, they're paying their wheat bill, they're paying down their dollar-denominated debt. And all of a sudden, 3 months later, the dollar goes up in value by 10%, and commodity prices denominated in dollars increase. And all of a sudden, they're in a position where they're basically bust. But unfortunately, it's not just the price of oil. Let's go through some other very important commodities. Heating oil, also up in the last 3 months. Let's look at a 5-year chart and compare this to the lows during the cerveza sickness, right around 2020. You can see it's pretty much gone up in a straight line. Back then, 67 cents, and now right around $3. Let's go down to corn. You can see the exact same dynamic playing out here. In 2020, even in going into 2021, we were right around, let's say, $350. Now, that's at 476, even though it's come down dramatically. Look at soybeans, the exact same thing. And if we go over to a chart of beef, we see a massive increase. We're talking about an increase from, call it, 120 all the way up to $250. Now, I know a lot of you right about now are saying, oh, George, well, this isn't going to be a problem for that long because we've got the BRICS coming out with their own gold-backed currency. And pretty soon, nobody's going to settle in dollars. Okay, well, that in this case really doesn't matter. Why? Because we're talking about the dollar price. You could settle in your local currency all you want. The average Yo could settle in Chinese yuan, as an example. But that's not going to do him any good if the dollar price of oil is going from $73 up to $85. The fact of the matter, especially while the dollar is going up in value against the yuan, even if he wants to settle in the local currency, it doesn't change the fact that he needs way more of his local currency to buy the exact same amount of stuff. And if he can't afford to buy all those inputs for his widgets, then he goes out of business. The unemployment rate goes up. He defaults on his debt to the Eurodollar banks. That reduces dollar liquidity even further. And that's what creates this systemic risk that we're talking about, i.e., black swan event. But on the topic of the BRICS gold-backed currency and taking market share from the dollar, I want to pull up a chart that shows the dollar's use for international payments and compare this to the euro. And let's say we started talking about the BRICS gold-backed currency in Q4 of 2021. And therefore, since that time, everyone has been getting rid of their dollars. Well, at least that's the narrative. If you look at the chart, we can see that the dollar usage for international payments has actually gone up as an overall percentage. And look at what has happened, especially recently, to the percentage of euros that are being used. It's just falling off a cliff. So if you want to make an argument that the gold-backed currency or the BRICS currencies are becoming more and more popular, that may be true, but they're not stealing market share from the dollar. They're stealing market share from the euro. So when we're talking about the next black swan event, we're not talking about something that's going to happen in 10 years or 15 years. We're talking about something that will happen in the next year or maybe the next 2 years, in which case we can easily assume that the majority of global settlement is still going to happen in dollars and commodities will still be priced in dollars. Whoa, time out. I know a lot of you right about now are probably scratching your head and saying, okay, George, well, why do you think the dollar is going to continue to go up and up and up. I get what you're talking about with the technical analysis and whatnot, but from a fundamental standpoint, why would the dollar continue to go higher? Why won't it immediately crash? Well, it's a great question. I assume that most of you watching this video believe, or your base case is that the probability is very high that the global economy slows down. If the global economy slows down, that means these global businesses are making less money. And we talk about Evergrande or Country Garden as classic examples of this playing out right in front of our eyes with these real estate companies in China. Let's get right back to the whiteboard. And when you look at the balance sheets and this process, it becomes very easy to understand why there's a very high probability that the dollar goes straight up through these technical levels that we discussed before. So the average Yo, as we said earlier, has this dollar-denominated debt, and he does have cash flow coming in to pay that debt. But it's becoming more and more of a burden because the dollar is going up in value and his cash flow is decreasing. Well, the very last thing that he wants to do is default on his debt to the euro-dollar bank. So he's going to try to kick the can down the road as far as he can. Well, how's he going to do this? Well, he's actually going to look at his balance sheet asset and say, okay, well, I do have some savings, but all my savings is denominated in yuan. So we've got assets on the left, liabilities on the right. And of course, those liabilities, dollar-denominated debt. So what the average Yo is going to do is he's going to take the assets that he has and he's going to sell them in an effort to kick the can down the road to make these payments until he can maybe improve his business or the global economy starts to improve and then, or the dollar comes down and then he has enough yuan cash flow to go ahead and start making those payments again. Okay, well, let's think this through. If he's taking yuan off of his balance sheet and selling them to buy dollars to pay off his debt, well, that is increasing the supply of yuan circulating in the global economy, in the FX market, relative to the amount of dollars. So what does that do to the value of the dollar relative to the yuan? It makes it go straight up. So the bottom line is if you believe we are headed for a global economic slowdown, then you also have to believe that the highest probability is on the side of the dollar continuing to go up on the DXY against other currencies. Oh, wait a minute, George. Now there's one thing that you have not thought through. What if the average Yo has dollars on his balance sheet and he's going to start transacting in his local currency or the new BRICS gold-backed currency? We were talking about that earlier. Okay, well, that's a very valid point. Let's think that through. So if the average Yo says, you know what, I don't want these dollars anymore. We're going to just transact in rubles or the Indian rupee or whatever they choose. Okay, fine. What's going to happen? Well, those dollars are going to go off his balance sheet, go into the global economy, but they're going to recirculate to do what? Pay off dollar-denominated debt. And if they don't want those dollars, then they're not going to roll over that dollar-denominated debt. They're going to roll that over into a different currency. And therefore, the debt is going to be extinguished. Okay, but how were the dollars created to begin with? They were created by lending them into existence. So let's just assume for a moment that all of these countries drop the dollar. Well, that's fine. What's going to happen is the dollar-denominated debt is going to decrease. And if the dollar-denominated debt decreases, then what happens to the amount of dollars? They decrease at the exact same rate. So the ratio between debt and dollars doesn't change at all, regardless of how many average Yos are dumping the dollar. The problem still exists. Step number 3. Okay, so let's assume for a moment that we have this dollar black swan event. What are the central planners going to do? Well, you guys know the answer. They're going to come out with their solutions that turn out to be far worse than the problem itself. So this would not be the first time the dollar has gone parabolic and become a very big problem for the global economy, creating this dollar wrecking ball, if you will. It also happened in the mid 1980s. So let's go to Wikipedia really quick and see what happened. Well, you guys probably know exactly what they did. And this was the Plaza Accord. So the Plaza Accord was a joint agreement signed in September 22, 1985 at the Plaza Hotel in New York City between France, West Germany, Japan, United Kingdom, and the States, specifically to depreciate the US dollar. So the US dollar was way too high. In fact, let's go to a chart on the DXY and look at just how high the dollar was. It was at 150. 150. And that's when the central planners came in. Now, keep in mind, back then, we had a lot less dollar denominated debt globally. So I don't think they could get up to 150 again. That's why I think the magic number is probably around 120 or 130, like we discussed in step number 1. But what they did is they came out and artificially dropped the value of the dollar. They had to. They didn't have a choice. And I'd also like to point out that the result of Plaza Accord 1.0 was the dollar going down by roughly 50%. Okay, well, let's fast forward to today. And remember, we're at 106.5, so we get that resistance level at 112. We break through that, and the next level we're most likely going to is 120. So let's just assume for a moment that the central planners and the authoritarians at 120 wave the white flag and they say, no, 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 we've got to do a Plaza Accord 2.0. We have to depreciate the value of the dollar relative to other currencies. Problem solved, right? Well, it depends. If you're outside the United States, then yes, this does solve the problem. But if you're inside the United States, this could make the problem much, much worse. Let me explain. Let's go over to a chart of the United States CPI. And as you guys know, this is just the inflation number that they're willing to admit to. The real inflation number is much, much higher. But back in 2020, the end of 2020, the US CPI was right around, let's say, 1%. And then starting in 2021, it started to go much higher. I'm sure you guys remember this well. And it peaked out in July of 2022, year over year, at about 9%. Okay, well, why is this a big deal? Let's go back to the chart of the dollar and look at the exact same time frame, right around the beginning of 2021 to July of 2022. And we can see that the dollar went from 89 or 90 all the way up to almost 108. Okay, well, remember, all of the stuff that you buy at Walmart, Target, Home Depot is coming from another country. So if the value of the dollar is going up, that means the prices that you're paying for that stuff is going down. Well, the prices were going down relative to where they otherwise would be, but we still had 9% consumer price inflation. So what would US inflation have looked like if the dollar, instead of going from 90 up to 108, went from 90 all the way down to 45? That 9% year over year inflation would have been closer to probably 20 or 25% consumer price inflation. So my point is, if the dollar goes up to 120 and they come out with the Plaza Accord 2.0 to quote unquote solve the problem, that means that the dollar, if history is a teacher, goes down by 50%. So we go from 120 all the way down to 60. Okay, well, if we're importing the majority of the stuff that we buy at Home Depot, Target, and Walmart, then what's going to happen to consumer prices in the United States at a time when the US consumer is already being squeezed because their wages have not kept up with the price increases that we have seen over the last few years while the dollar was going up in value? And you might be saying to yourself, okay, George, well, it's definitely a domestic inflation problem that will crush the poor and middle class, but it might not be a black swan event. The central planners, by implementing this Plaza Accord 2.0, might avoid the worst case scenario. Okay, well, let's go over to a recent article from the Wall Street Journal. And I want to point out that small business bankruptcies are rising at the worst pace since the cerveza sickness. And why are they rising? And keep in mind, the amount of bankruptcies only represent about 10% of the businesses that are actually going bust. Let's dive into the article so we can understand why all these small businesses are filing bankruptcies. The Wall Street Journal gives the example of an Orlando, Florida trucking company. They paid high prices for a lot of these trucks as the cost of new and used vehicles climbed in response to the cerveza sickness, or the government's response to cerveza sickness. Let's be very clear. The company believed demand would remain strong, Patrick Pinto said, but shipping rates have fallen by roughly 50%, and fuel and insurance costs have climbed. So you see what's happening here, guys. A lot of people say, well, we shouldn't worry about businesses going bust because if they have higher input costs, well, they can just pass that cost on to the consumer. No, 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 no. That's only if the consumer's income is increasing. If the consumer's income is decreasing in real terms, they have less purchasing power. Therefore, these businesses cannot increase prices because they're seeing demand plummet. They're seeing their revenue go down. How do you raise prices in that environment? So what ends up happening is their input costs go higher and higher and higher. Their margins go lower and lower and lower until a point where they go out of business. So if the United States comes out with, let's say, a Plaza Accord 2.0, and that drops the value of the dollar down by 50%, they may solve the problem, the global economy, but that's going to crush the US economy. It's going to crush small and mid-sized businesses here that can't pass on that additional cost to the consumer. And therefore, they're going to close their doors, and that's going to increase the unemployment rate dramatically, which many might put into the category of an economic depression as opposed to a black swan event. But for the average American, I don't think it makes any difference at all. The net result is the exact same. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.